There were 2 points that we were bringing up that were very important. Number one is the Fed acknowledging economic conditions have improved somewhat since the last statement back in January. So they said the economy's been expanding at a moderate pace. Prior comments were economic growth slowed last year. That was the January comment. So there's number one. They got what they wanted, a modest acknowledgement that the economy is improving. The second and the trickier one was lowering their interest rate forecast. Remember, they were expecting 4 back in December, and as you heard from Steve, now it's essentially 2 rate hikes. That is the most important part of the entire announcement right there, because there was a lot of concern that they may not do it as aggressively as the street had been expecting. Now, they didn't change much on the inflation forecast, but, you know, as we've been saying, those core PCE prices at 1.7%, that's up a little bit. That gives them a little cover as well. So the bottom line here is what's happened is the Fed has come to the streets position, essentially. And that's why you're seeing a rally, despite the implication that there may be rate hikes down the road. The Fed, the street has already essentially tried to price in 2 rate hikes. So overall, this is exactly what the market was anticipating. And you can see a fairly favorable reaction at this point.
But Bob, and we want to be clear to the audience, the Fed is not saying in the press release, we will raise rates 2 times. It is the economic projection of 0.9% on Fed funds from 1.4, so you add 50 basis points, so you take it 3 to 2. Projections can change. I mean, they don't have to do this. They could change it next week.
But that's exactly what the street is expecting. The Fed has come to the street at this point. That's why you're seeing this kind of favorable reaction. It's already been discussed and digested.
That's the underscore part of what you said, meeting the street expectations, and that's why we are seeing I would say a muted reaction on the street and a very quiet on the dollar front, because that's where we would have seen the extreme reaction should the Fed been too dovish or too hawkish. And right now the dollar index is lockstep with where it was trading before.
But wouldn't you agree, Melissa? I think they'd be very relieved to see the market response, right? I mean, the dollar's not going higher, right?
It's not moving too much.
Right. It's the Goldilocks response.
Right, exactly.
But you know, one thing, Michelle, is that when you consider, or sorry, Melissa, when you consider that they have just violated the data-dependent forward guidance they gave us, right? They have said that as we approach full employment, as inflation rises, we have to normalize rates.
And they're not doing that.
No, they're not doing it. And so, to your point, it's the party's on. Buy risk assets.
Yeah.
We're just going to keep the thing going.
It's free money for a much longer time than we thought, is the bottom line here with what they're saying. Bob.